Now we saw we saw two Ford futures hedge and the money market hedge. There may be some problem of them actually though. So shortcoming of these hedging is I mean the good thing is they can completely eliminate this exchange rate exposure, but it does not. That's it. Just I mean, they have to give up some type of the favorable exchange rate changes, because sometimes if the exchange rate change is favorable to them, then the companies want to take the advantage of them. If they just use the forward futures contract or the money market securities, then they cannot take the advantage of them. So instead of these two features, we can use option to currency option to pursue this benefit. So currency options provide more such a flexible optional hedge against exchange exposure. Basically, what they can do is that the firm may buy foreign currency call option or put option to hedge its foreign currency payable or receivables. So let's look at the example. Suppose that the Boeing Corporation exported the Boeing 737 to British Airways and billed 10 million pounds payable in 1 year. And US interest rate is 6.1%, UK interest rate is 9%, spot exchange rate is $1.50 per pound, and forward exchange rate in 1 year is 1.46 per pound. So generally speaking, what they should do is the Boeing, I mean, they have payables, right? Boeing has receivables, I mean. So Boeing has receivable, the British Airways has payable. So Boeing need to buy the put option to hedge its foreign currency receivables. So suppose Boeing purchased a put option, because this put option is used when they hedge receivable, right? On 10 million pounds with exercise price is the same as the forward the rate, so 1.46 per the pounds. Is option premium of 2 cents per pound. Because of that, they pay $200,000 because it's 2 cents times 10 million pounds, right? So 200,000 is the cost of this option they need to pay. Now suppose the spot exchange become $1.30 on the expiration date. Because they have put option, now spot rate ST is actually below exercise price. That case, they exercise option. So put option holder exercise the option. Since he can sell a pounds for $1.46, which is higher than spot rate, right? So this is good for put holder. So the main advantage of this option hedging is that the firm can decide whether to exercise the option based on the realized spot exchange rate on the expiration date. If you consider time value of money, the upfront cost is same as $200,000 times 1 plus 6.1% interest rate in the United States. So it's going to be $212,200 will be the cost of them. So net dollar proceeds is from these sales, you are guaranteed to receive 14,600,000, right? Because this is guaranteed price. But you pay, the difference is 212,200. So eventually net dollar amount will be $14,387,800. That's the net dollar proceeds from the British sales. So if you look at this graph, you can clearly see the benefit of option hedge and also the cost. Comparing the forward hedge is simply just flat. So you can buy the forward contract like the short of forward, buy the forward contract like this, right? However, You buy your option. So after this exercise price, basically you will get benefit. We will have benefit. And after this break-even point, which is $1.48, because the 2 cents is the cost of option, right? So if the spot price hit the $1.48, then you start to make money. So you get benefit for this. If the exchange rate is favorable moved, then this option holder can get benefit. For forward rate, nothing happened. However, there's a cost of the option because the option is the right, so you need to pay premium, which means that you have to pay these costs to take these opportunities. So that's the cost to take the opportunities. Okay, so instead of forward contract or money market funds, if you want to take advantage of changing in exchange rate favorable to you, then you need to buy option. There will be the cost, but you will get better off if exchange rate changes favor to you. Okay, favor to you.